All right. Well, good evening, everyone, and welcome back to, I guess, what is technically week number four. Even though this is not our fourth Zoom session, it is week number four of the class. So after tonight, we have two Zoom sessions left, and then we are done for the summer. So as always, the summer session goes by very, very quickly when you only have 6 weeks together. Just really flies by in the blink of an eye, and so it's doing the same thing this summer. We are going to play a little bit of catch up tonight to catch up on some of the material that we weren't able to cover yet because we had that holiday that interrupted us, but should be able to cover all of our information tonight and get right back on schedule, and should be in good shape then to finish up the class and cover all of our material. Thank you very much for your pre-instructional assignments. I've gone through and returned all those. Again, it really is just truly an assessment, so there aren't right or wrong answers, and so I didn't provide a whole lot of feedback on it. Just essentially thanked you for the assessment because you're going to be redoing that assessment then in part one of the post-instructional. So those 8 questions are going to be answered again once you get to the post-instructional assignment. So I don't think there's a lot of need for me to provide feedback now because I'll be providing feedback once we get to the end of the class in the post-instructional assignment. Same type of thing for your beach board number 2. Didn't provide a lot of feedback on that one because, again, you're going to be assessing your budget in the budget format later on in the post-instructional assignment. So that is all done. Then coming up this Sunday on the 19th, you have your third beach board essay due. And for that third beach board essay, what you'll do is you will obtain the annual financial report for your city. Now, some cities refer to it, as we said before, as a comprehensive annual financial report. Some have now started to refer to it as the annual comprehensive financial report. Whatever terminology they use, it's the exact same type of document. And I always tell folks, if you really want to get a good holistic view of the fiscal picture in a city, the 2 primary documents you need is you need the budget and you need the annual financial report. The budget is a prospective document. So the budget tells us how we are going to spend our money in the next fiscal year and what we're going to be spending that money on. The annual financial report is a retrospective document. So a primary element of the annual financial report is that report will document how we spent our money in the past fiscal year. And so it does give us that retrospective analysis of how we actually implement the budget in that previous fiscal year. So you put the 2 together, your prospective budget, your retrospective annual financial report, and you get a pretty good holistic picture of the finances of your city. Now, for this beach board essay number 3, what you'll be doing is, again, getting a copy of the annual financial report, which you should easily be able to download from the city's website. Look through the report. I will warn you that annual financial reports can be relatively lengthy. It's not unusual for them to be 200 or 300 pages in length. But as we'll talk about tonight, there's one section of the report that is written to give you a good snapshot of the financial health of the city. And that's a section of the report known as the management discussion and analysis. The management discussion analysis, every comprehensive financial report produced by a city, if they are in compliance with the Government Accounting Standards Board requirements, that comprehensive annual financial report will have a management discussion and analysis section. That section usually is anywhere from 10 to 20, 30 pages in length, will provide you with a narrative overview of everything that's found in the comprehensive financial report. So it is designed to make the financial report a little bit more user-friendly for citizens, so citizens don't have to go through and wade through all the tables, the balance sheets, and the balancing sheets, and balancing assets and liabilities, and all those good things. They can read the narrative and the management discussion and analysis section and get a really good sense of the finances of the city. So I would recommend that when you get that financial report, look at the management discussion analysis section, at least to start with, to get a good idea of the overview of the finances for the city. And then tonight, what we're going to do in class is we're going to talk about some specific indicators of fiscal solvency. So once we're done with class tonight, you'll have several different indicators of fiscal solvency you can choose from in assessing the fiscal solvency of your city. So for Beach Board essay number 3, you're going to take that annual financial report, review it, and then come to a conclusion about the fiscal solvency of the city based upon your reading of that annual financial report. And then also not only come to a conclusion about fiscal solvency, but to compare your conclusion on fiscal solvency you came to after reading the comprehensive financial report as compared to the conclusion you came to when you read the budget for the pre-instructional assignment. I know a lot of folks didn't answer that question and say, I don't have the information yet to assess fiscal solvency. So that's fine. But on this Beach Board essay number 3, you'll just be telling me, here's my conclusion from the annual financial report about fiscal solvency. And this was something I was not able to do in the pre-instructional assignment when I looked at the budget. And that's an acceptable answer. So assess the fiscal solvency, and then how did your assessment differ from your assessment of fiscal solvency upon your initial reading of the budget in the pre-instructional assignment. Now, you'll see tonight as we talk about different indicators of fiscal solvency, I'm going to introduce you to the Brown's 10-point scale, 10-point indicators of fiscal solvency. I'll also introduce you to Wang, Tu, and Dennis's indicators for fiscal solvency. So I'm going to introduce you to probably about, I think it's somewhere around 18 to 20 different possible ways of measuring fiscal solvency. You certainly don't have to incorporate all of those in your Beach Board essay for this week. Just pick maybe 2 or 3 of those indicators we talk about and focus on those to help you assess the fiscal solvency of your city. So 2 or 3 out of all the dozens we talked about tonight certainly would be sufficient for Beach Board essay number 3. So you've got Beach Board essay number 3 then due on Sunday. Tonight, what we're going to do is we're going to again break the class up into 2 different segments. In the first segment of the class, we're going to catch up with our discussion of analysis and accounting and budgeting. Then we'll also talk about fiscal solvency indicators, take a break for a few minutes, and then the second half of class, we will turn our attention to capital budgeting and debt management. So kind of 2 sections of the class and 2 really completely different topics, but that's kind of the nature of the beast in a 6-week class. You have to cover all the material. So sometimes when you play catch up like this, your 2 topics for the night may not meld together all that well, but there is certainly a good overlap between them, because one of the primary reasons why we do analysis and budgeting, as we'll see in our discussion in the first half of class, is to analyze these capital projects and to analyze which capital projects we want to fund and in what given year we want to fund those projects. So analysis in the first half, capital budgeting and debt management in the second half. All righty. Okay, so that is our agenda for the evening, and that's where we are currently in the class. One last housekeeping point before we get into our material for tonight. The final assessment that you have for this class, I have made available on our Beach Board site. Now, it's not due until July 1st, so you have quite a bit of time to work on it. I usually make it available 2 weeks before the final due date, but I thought I'd make it available a little bit earlier for you. So it is available. You can go and start working on that anytime that you want. It's located under the content section of the class. You'll see final assessment or final exam, whatever I call it. And that will be your final assessment for the class. 5 scenarios that I've written, and then you will answer 2 questions related to each of those scenarios, demonstrating your ability to take the information you've learned from the class and then apply that information appropriately to address those 5 different scenarios. Again, no right or wrong answers. Your answers on the final assessment will be graded based upon your justification for your answers. If time permits next week, which I think it probably will, I'll pull up the final assessment and we'll go through the 5 different scenarios, and I'll show you what I'm looking for and give you a few little clues about the final assessment next week. So we'll do that in class next week, as well as talking about revenue and taxation in next week's class. All righty? Okay. Again, our first topic for tonight is analysis and budgeting. And this is, admittedly a difficult topic sometimes to cover, because in this 555 class, I know we have folks from a lot of different budgeting backgrounds. I know we have some people who have dealt with budgets extensively in their careers. We have some people who have not dealt with budgets at all in their careers. And so it kind of makes it a little challenging to talk about analysis and budgeting. So the way we do it in this class is we're going to kind of do it from that 30,000-foot helicopter level, and that we're kind of do the broad brushstrokes of analysis and budgeting without really getting into all of the particulars. Now, there are some specifics we're going to get into with growth rates and revenue projections and things such as that. But for the most part, we're going to try and keep it at that 30,000-foot level. And what I found over the years is the best way to talk about budget analysis is to talk about it according to the purpose that we're analyzing a budget for. So we're going to organize our discussion time around the purpose that we're analyzing the budget for, and then talk about some of the discrete tools and skills that you can use to analyze the budget for that particular purpose. And I've really found that organizing this discussion around the purpose we're using analysis for is very helpful in kind of conveying the information a little bit better, a little bit more efficiently. So the first reason or the first purpose that we analyze budgets is we analyze budgets for the purpose of forecasting our revenues. Now, when we talked about the budgeting process, we talked about the preparation phase, that first phase of budgeting. We said in preparation, OMB, CBO, the Joint Commission on Taxation, these different organizations will put together their revenue forecasts. Here in California, the Department of Finance and the Legislative Analyst's Office will put together their own revenue forecast. So there must be some methods that are commonly used in forecasting revenue. Obviously, you don't know how much money to spend unless you know how much money you have coming in revenue. Because we always have to balance our revenues and our expenditures, or attempt to, at the state and the local levels of government. So how do we analyze in order to try and forecast our revenues? Well, one very simple way to do revenue forecasting is just through univariate analysis. As you know, univariate means one variable. So in univariate analysis, we are going to look at our past trends in revenue forecasting. And we're then going to take the average of the revenue that we have generated in the past and then use that average as our forecast for the next fiscal year. Again, our goal in revenue forecasting is obviously to be as accurate as we can possibly be. So we want our revenues to come as close as we can to matching the actual amount of revenue that we generate in that fiscal year. In order to produce accurate revenue forecasts, we're probably going to have to take a lot of information into account. When we do univariate analysis, we're only taking into account how much we've raised in previous years. And so we're not taking a whole lot of detail into account in putting together our revenue forecast. Two really quick and easy univariate ways of forecasting revenue are approaches known as prior moving averages and prior moving changes. And if you use Excel, you know Excel will do this for you. In prior moving averages, what you'll do is you'll take the average amount of revenue from the preceding 3 fiscal years and then use that average as your projection for the revenue in the upcoming fiscal year. So, just to keep it simple, if you had generated $100 and then $200 and then $300 in revenue, and then you wanted to forecast next year, you would take the average, which would be $200, and then $200 would be your forecast for the next fiscal year. Well, clearly, if you raised $300 last year and you're going to forecast you're raising $200 next year because that's the average of the preceding 3 fiscal years, there's a very good chance that you are under forecasting and underestimating your revenue. And that's the problem with prior moving averages. It serially under forecasts the amount of revenue you're going to generate in the future year. It's a very conservative way of forecasting revenue. A similar approach to prior moving averages is prior moving changes. You look at your percent changes between your preceding 3 fiscal years. You take the average of those percent changes, and then you use that average percent change as your forecast for the next fiscal year. So if you find out the preceding 3 fiscal years, revenue is increased by an average of 2% per year. You take the amount that you raised last year, multiply it times 1.02, add 2% to it, and that'll be your forecast for the next fiscal year. Again, suffers from similar issues that you have with prior moving averages. So we have to be really careful with these univariate approaches when we have upward trend lines in our revenue. So if our revenue is going up year after year and we use a univariate approach, we're going to underestimate, underforecast our revenue for the next fiscal year. But it's a really quick, simple way of forecasting revenue. Another way of forecasting revenue that's a little bit more sophisticated, but not much, is what you learned in social science research. And if you had 696, what you've talked about in 696, which is basically bivariate regression. It's a bivariate analysis where we will take another variable and we'll look at the relationship, the correlation between that variable and the amount of revenue that we are going to generate next year. Here in the world of public budgeting, we refer to bivariate analysis as deterministic modeling. So if you see someone talk about deterministic modeling, they're talking about bivariate regression. So for instance, if we want to try and forecast the amount of federal income tax revenue we're going to generate in the next fiscal year, we may take a variable such as our gross domestic product. And we'll use the change in the gross domestic product to help us forecast the change in the amount of federal income tax revenue we will generate. At a local level, if you want to try and forecast the amount of property tax revenue you're going to generate next year, you may take a variable such as your changes in your property tax base, the assessed value of, maybe we'll say you want to forecast corporate property revenue, you'll take the assessed value of corporate property value in your jurisdiction and use that then to then predict the amount of corporate property tax revenue you'll generate next year. We're using only one variable to then predict your revenue for the future year. It's called deterministic modeling. Well, as you know, I'm sure from social science research, and you certainly know if you took the 696 class, usually bivariate analysis is too simplistic for the real world. Usually variables and phenomena are not fully explained by only one other variable. Usually phenomena must be explained by taking into account multiple variables and multiple considerations. So a more advanced technique would be applying something like multiple regression analysis. And there are a lot of ways to do multiple regression analysis. In this class, we're just kind of grouping them all together into this classification called multiple regression. In multiple regression analysis, we're going to use multiple variables to help us predict and forecast the amount of revenue we're going to generate next year. So we're just not going to use GDP, we're going to use multiple variables. So we might include an unemployment rate, we might include some indicators of inflation, or things such as that. So we'll have multiple independent variables that will then predict the amount of revenue that we will be generating. Now, again, with multiple regression analysis, the quality of your multiple regression model is going to be predicated upon how accurate your predictions are. So at the end of the day, what we'll do is we'll take that revenue prediction and we'll then compare it with the actual amount of revenue that we generated in that fiscal year. Any difference between our prediction and the actual amount that we generated, that's going to be unexplained variation. That's what we call unexplained variation in multiple regression. And all of that unexplained variation then falls into that E term at the end of that equation. So on the slide, you've got your basic multiple regression equation. And then always at the end of your multiple regression equations, you have this plus E term. E stands for error. So error is the difference between your prediction and what actually happened. In multiple regression, we just take all of that unexplained variation and we just dump it into an error term. We don't really worry too much about it. We don't really worry about what's in that error term. We just dump it in the error term and we then move on with our predictions. Now, if you look at here in the state of California this year, for one of your beach board assignments, you went and reviewed the governor's budget, and then you reviewed the May revise and what happened after the May revise. as we had talked about, after the May revise, we realized that we had generated a lot more revenue in the state of California than we thought we were going to generate. So our actual revenue generation was actually much higher than our forecast. So there's a great deal of error. There's a great deal of unexplained variation there. That if you're just using multiple regression, you just toss in your error term and you're done. Obviously, you really want to know where that unexplained variation is coming from. You really want to ask the question, why are your forecasts different, substantially different than what actually happened? If you really want to know why, you really want to get into that unexplained variation and dig into that error term, then you're going to have to use an approach, something like econometrics. So econometrics kind of ratchets up the sophistication one more notch above multiple regression and really gets into the error term to try and explain some of that unexplained variation between your actual amount of revenue you generated and your prediction, your forecast. Econometrics is oftentimes good to use if your independent variables are not truly independent of each other. Now, again, if you remember regression analysis from your undergrad stats or from 696, you'll know that for a simple form of multiple regression analysis to work, your independent variables must be truly independent of each other. But we know sometimes they're not independent of each other, especially in the world of taxation. Tax sources oftentimes are codependent upon each other. So if you think about something such as if you have one variable which is, we'll say one variable is, economic activity, however you're measuring that economic activity. Maybe we'll say we're going to measure it in terms of the value of transactions in a given year in a jurisdiction. Well, you know that the amount of transactions and the value of those transactions will probably be directly correlated with something like unemployment rates. As unemployment rates go up, people are out of work, they don't have as much disposable income, so they're not going to be buying as much, and so the value of commodities transacted in the jurisdiction will probably go down as a result of unemployment. So if you're using those as two of your variables, they are correlated with each other. It's a problem in statistics that we call multicollinearity. And multicollinearity can be really troublesome whenever you're trying to make accurate forecasts, revenue forecasts. So econometrics is a way in which we can get around that and control for some of that multicollinearity within our variables. Now, it's well beyond our scope in this class to get into the details of econometrics. There are entire courses that are taught on econometrics. If you're interested in econometrics, Paul Kennedy has a great book called Introduction to Econometrics that will kind of walk you through what econometrics are and how econometrics work. But for our purposes, it's important for us to know that it's a more sophisticated way of forecasting revenue, and it's a way of forecasting revenue that really has become very much the norm, especially at higher levels of government. So at the national and state levels, most state governments, and certainly the national government, will engage in some version of econometrics in making their revenue forecast. Now, rarely do we see something like econometrics used at the local level. The rule of thumb is usually at the local level, as you move down the intergovernmental system, your revenue forecasting approaches tend to become less and less sophisticated, which just makes sense because of limitation of resources and things such as that. Just to give you a real quick aside, is for 4 years I taught budgeting in the state of Illinois, and at the end of every semester, I would get a call from the state budget office in Illinois asking me if I had any budgeting students who were graduating that semester who were interested in becoming budget analysts. And so I would pass on the information to those students. I had several students who ended up becoming budget analysts, going and working in the state budget office, because it was a really great stepping stone. Because as a budget analyst, you really get to know people in the agencies and departments in the state government that you're working with, and they then get hired into those agencies and those departments, sometimes get hired on by state legislators. It was a really nice stepping stone for those students. But my first couple of years when I was in Illinois, when I would get those calls, they would ask for students who completed the budgeting course with a B or better, who were graduating getting their master's degree that semester, and who knew multiple regression analysis. And that was the minimum requirement my first couple of years. By the time I left the university after 4 years, the state budget office was no longer asking for people who could do multiple regression. They were asking for people who were proficient in econometrics. And so just in that 4-year period of time, their expectations for the budget analysts had changed that much. And again, that was many years ago. So even back then, states were becoming much more sophisticated to try and develop the most accurate predictions possible. Microdata simulations, and yeah, it's true what Jay's saying. He started a master in economics. It seemed to be all about econometrics. Yeah, in the world of business and schools of business, and certainly in departments of economics, econometrics are taught very frequently, and you're going to learn econometrics from the moment you move in, and then all the way through the program. We don't do that so much here in the MPA program. We just kind of make you aware of it because you're not going to have to use econometrics or anything like that on your case studies. Microdata simulations is another approach to try and forecast revenue. And I mentioned this one because it can become very political and it can become very contentious, especially when we have tax legislation. So whenever we have tax legislation making its way through Congress, and that tax legislation will call for tax breaks, tax cuts for certain taxpayers, we know that in the near term, those tax breaks will then reduce the amount of revenue coming into the federal government. But the idea behind those tax breaks is that they will then stimulate the economy. And as they stimulate the economy, then in future out years, those tax breaks will actually hopefully generate more revenue for the federal government through economic stimulation. So with microdata simulations, what we're going to do is we're going to measure the impact of this tax legislation on taxpayers to see how it will change their behavior and how that changing taxpayer behavior will then result in changing levels of revenue in future fiscal years. The two basic approaches to using microdata simulations is you can simulate in a static manner or in a dynamic manner, what's called static scoring or dynamic scoring. Scoring is a term used by Congress whenever they assign a price tag to a piece of legislation. So whenever they're talking about passing a piece of legislation and they score it, they are assigning a price tag to it. How much is this legislation going to cost us in federal income taxes? A static scoring approach would not take into account the possibility of future increases in revenue as a result of this piece of legislation. A dynamic scoring model will build in assumptions of how in the out years this tax break will end up increasing revenue. And so, for instance, in the last tax bill that came through, the big tax bill in 2017, that was the really big one, the Tax Cuts and Jobs Act, I believe it was called, in 2017. In that piece of legislation, Democrats scored it in a static model, Republicans scored it in a dynamic model. And so when Democrats used a static model, they would say, this is going to cost us this immense amount of revenue because you're cutting the tax bill that people are paying. Republicans argue it's going to pay for itself and then some in future years because it's going to stimulate the economy. And they took in these assumptions of economic stimulation into account in their revenue forecasts. So whether you use a static scoring model or a dynamic scoring model will have a major impact upon your revenue forecasts. And so oftentimes it's political, that if you're really supporting a tax break, then you're probably going to want to use a dynamic scoring model. If you're opposed to tax break, you're probably going to use a static scoring model. But we have to forecast revenue. That's one of the major things that we do when we analyze our public budgets. Usually when we are forecasting in a very simplistic way, we are going to calculate our growth rates and then use those revenue growth rates then to make projections for future revenue growth in our out years. So the really basic way in which you calculate a growth rate is the formula on the screen. You're not going to have to use that in this class, depending upon when you do your 697 case study. It may be something that could come in handy on the 697 case study. But to calculate a really simple growth rate, it's a simple formula there. The XL in the formula stands for the value at your last time period. So that would be the last tax revenue that you generate, the last amount of tax revenue you generated in that last year. X1 will be the value in your first period, meaning the amount of revenue that you generated when you, in the very first period of your analysis. So it could be last year or 2 years ago or 3 years ago, however many years you're using for your growth rates and projections. And then the T variable is the number of time intervals or time periods. So again, if you're only going to forecast, use last year's revenue generation to forecast next year's, then your T is going to be 1. If you're going to use last year's and then forecast 2 years out in the future, then it's going to be 2, and so on and so on. So that's just the number of years that you are using in your analysis. So using that simple formula will then give you your growth rate. It will tell you your percentage increase in revenue from 1 year to the next. So under growth rate on the screen, you'll see a real simple calculation based upon a case study that we used in budgeting a couple of years ago. So in this one, you are calculating a growth rate where you had $675,018 in revenue in your last year, $648,747 in revenue the preceding year. Since you're comparing the preceding year to last year, so 2 years ago to last year, there's only 1 year in between there, so your T becomes a 1. You work through the calculation, you end up with a growth rate of 4.05%. So from 1 year to the next, revenue grew by 4.05%. That's your growth rate. You can then take that growth rate and you can utilize that growth rate to then make your future revenue projections. And to do that, then you would use the formula that's under the projection for 2 years in the future heading. F equals XL times 1 plus R raised to the I power. Again, XL is the amount of revenue in your last period. The R is the growth rate that you just calculated, the 4.05%. If you're going to forecast 2 years in the future, then your I exponent becomes 2. So you work through that formula and you'll see that with a 4.05% growth rate, given $675,018 generated last year, we would forecast that 2 years in the future, we'll be able to generate $730,801. Just a real simple example of how you calculate a growth rate and then utilize that growth rate to then make a revenue projection. Again, this is something that is univariate in nature. This is something very simple in nature. You're not taking into account all these other variables. You're just using the information you have at your disposal, which is the amount of revenue that you generated in previous years. But we emphasize this because this is something that's frequently used at the local level, especially for smaller governments, a really quick and really easy way to make revenue projections. But that's one of the primary reasons why we do analysis and budgeting is to forecast our revenues. But we also do analysis and budgeting to estimate our costs. You know, there are two sides to the coin. There's the revenue side and there's the expenditure side. So we also need to estimate the cost that we're going to be incurring as an agency or as a government. Personnel costs are relatively straightforward to do. You know you have salaries, you know that you have benefits, and the value of those salaries and those benefits will give you your personnel costs. But not all of our costs are personnel related. We do know that about 85 to 90% of most public budgets are going to be personnel related. But that still leaves you about 10 or 15% that will be for non-personnel costs. Sometimes you'll need to purchase supplies, obviously, and supplies pretty easy cost estimation. The volume of supply that you're buying multiplied times the unit price. You know, we do this every day in our personal lives, so a pretty simple calculation. We also know we do a lot of contracting out. We bring in a lot of consultants. Well, how much will your consultant cost? Well, you're going to have to know the cost per day for that consultant and the number of days you're going to be hiring that consultant. So it's a workload times average unit cost type of estimation. Sometimes we like to compare apples and oranges. We're going to come up with these workforce ratios, things such as the ratio of vehicles to staff members. So how many vehicles do we have per staff member? Say if we have 10 vehicles, we have 100 staff members, we have 1 vehicle per 10 staff members. A real quick workforce type of ratio. The one we use a lot in estimating our costs is adjustment to prior year. So we're going to use some type of an index to then allow us to adjust the value of cost this year compared to what they would have been worth in previous years. The Consumer Price Index, the CPI, is one index that we oftentimes use to adjust the value of money from one year to the next. There's also what's called a cost of doing business factor, and sometimes state governments will include a cost of doing business factor for the appropriations they give to local governments. But again, the value of money is going to be different between years, and so you need to have something to allow you to adjust the value of cost from one year to the next year. So we do a lot of cost estimation in addition to our revenue forecasting. Now, as governmental organizations, or even as a nonprofit organization, we operate with this nonprofit mentality. Unless we're a government corporation or a government-sponsored enterprise, a GSE, chances are we're going to be working from a nonprofit orientation, which means that we are not generating a profit, and so therefore we need to know how much output to create in order to balance our revenues with our costs. If our costs outstrip our revenues, then obviously we're in a deficit. That's going to be a problem. If our revenues outstrip our costs, then we are no longer operating in a nonprofit type of mentality. So that's where you have this approach known as a break-even analysis, used very frequently, especially for agencies and organizations that are producing some type of an output that can be monetized. And so an example here, just show you a real quick break-even analysis, and Mike So uses this example, is if you have trash collection services. So you've got this waste management authority, and the waste management authority charges $2 per 40-gallon container that they collect. So if they're charging $2 per container that they collect, then the revenue that they're generating will be 2 times Q. $2 times Q meaning the quantity of the 40-gallon containers they're collecting. So the total revenue is going to be $2 times how many units you're collecting. In terms of your costs, as you know, from an economic perspective, you typically have fixed costs and variable costs. Fixed costs are your costs irrespective of how many containers you are collecting. Variable costs will be indexed to each unit collected. So the variable cost will be a cost that's incurred with each unit collected. The fixed costs are costs irrespective of how many units you're collecting. So fixed costs are things such as administration, things like salaries, equipment leases. Those are your fixed costs. So in this example, fixed costs add up to a total of $120,000. You have $120,000 in fixed costs. Then for your variable costs, for each container that you are collecting and taking to the landfill, you have to tip the landfill $1 per container you're taking to the landfill. So you've got $1 in landfill tipping charges per container. You have a 15-cent cost in equipment operation per container, a 25-cent per container cost to pay your collection crew, which adds up to $1.40 per container in variable costs. So your total costs are going to be your fixed costs plus those variable costs. As we said, your total revenue will be the $2 times the amount of the quantity that you are collecting, which is your Q. And that's what we're going to solve for here in our break-even analysis. So where we need to break even is we need to break even at the point where total revenue is equal to total cost. So if total revenue is 2Q, that gets on the left side of the equation, our total costs, our fixed costs of $120,000 plus $1.40 times Q, $1.40 per unit that's being collected, You work through that equation, you have to isolate your Q's, so you subtract your 1.4, you end up with 0.6 Q equals your 120,000, divide 120,000 by 0.6, you end up with a Q of 200,000, meaning that if we collect 200,000 containers at $2 per container, we are going to break even. That break-even analysis, again, is done to make sure we're operating at that point where our total revenues are equal to our total costs. Again, it's going to be germane if you are an agency that's producing some type of an output that can be monetized and that you can charge for. So essentially, some type of output whereby you have some element of a private good at play here, because you've got some ability to charge people for the benefit that they're getting from having their waste disposal container collected by this waste management authority. So sometimes we do analysis for the purpose of finding where we can break even. A very common type of analysis we do in budgeting is a cost-benefit analysis. And again, some people call this benefit-cost analysis, depends upon whether you're a pessimist or an optimist. I guess the pessimists say cost-benefit, the optimists say benefit-cost. I tend to be a pessimist, so I say cost-benefit analysis. In a cost-benefit analysis, again, there are a lot of approaches to cost-benefit analysis, but just generally, a cost-benefit analysis, you will identify your objectives, what you're trying to achieve with this project or this program, and you're going to try and identify and monetize your costs and your benefits. Now, the problem for us is that costs and benefits, number one, are sometimes not that easy to monetize. And I won't take you through the example I usually do because it's a very long example. We don't have the time for it. But just to make it very quick, in the example that I usually like to use, the government is thinking about increasing the tax on alcoholic beverages. So they have to determine how much will it cost us to increase the tax on alcoholic beverages and what types of benefits will accrue if we increase the cost of alcoholic beverages through an increase in taxation. Well, obviously, some of the cost is that if you're increasing the price, there are going to be some production side costs that are going to be paid. Because if you're increasing the price and people are purchasing less of it, then there's less need for the private sector to produce it, which means you may have some people who are laid off and you may have these distilleries that are slowing down their operations. So there could be some supply side, some production side costs. But you also know that there are some benefits that will accrue as well. That if you increase the tax, the price goes up, then if it's a very price elastic good, then demand will probably go down. As you increase the price, demand goes down. But it's not that easy, in that you need to know that different alcoholic beverages have different price elasticities. And again, by price elasticity, we just mean how does demand change if price goes up or goes down. So for instance, if you're looking at the market for beer, beer has a different price elasticity than wine sales. Wine will have a different price elasticity than hard liquor. And to confuse it even more, there are different audiences for those three different types of alcoholic beverages that all have different elasticities as well. So if you're talking about young people tend to have less elasticity when it comes to beer, but more elasticity when it comes to wine and hard liquor. For older individuals, they have less elasticity for wine and liquor, and they have more price elasticity when it comes to beer. So you can kind of just see how the ball starts rolling downhill. It becomes more and more complicated once you really start looking into identifying and monetizing all these costs and all these benefits. And that doesn't even get into the discussion that you would obviously have to have about, well, if you're reducing consumption of alcoholic beverages, you're probably going to reduce the amount of drunk driving incidents. Well, if you reduce the amount of drunk driving incidents, then what are some of the benefits of that? Well, you're going to reduce property damage. You're hopefully going to have fewer insurance claims and hopefully fewer lost lives. Well, how do you monetize human life? Well, our insurance companies do it every single day. They have their tables that they can tell us based upon how old you are, what you do for a living, what your lifetime earning potential is, how many people rely upon you. for their financial wherewithal. They've got a whole lot of different factors they can use to put a dollar value on a human life. But again, the dollar value put on a human life oftentimes depends on your proximity to that human life. So it becomes very difficult for us to sometimes monetize all the benefits and all the costs associated with a certain course of action. That's why cost benefit analysis is usually not used as the exclusive tool to make decisions in budgeting. It's a good supplemental tool, but it's usually never the only tool that is used in doing a budget analysis. But you have to try to identify and monetize your costs and your benefits. But to complicate it even more, not all costs and not all benefits occur at the same time. So you think about if you're going to be choosing between constructing a senior citizen center and constructing a recreation center. Well, there are going to be benefits that will accrue from construction of the senior center, benefits that will accrue from construction of the recreation center. However, those benefits may not all come at once. So you may have some benefits that come in right away for as soon as that recreation center opens, but some of the benefits may take some time. And so, people using that recreation center over a period of time, if they continue to use it, they are probably going to become healthier. Hopefully, as they become healthier and more fit, they're going to miss fewer days of work and productivity in the area will go up. There'll be fewer insurance claims and so on and so on. But those benefits are going to take some time. However, if you're charging a fee for people to use that recreation center, they're going to pay that fee as soon as they sign up. So those benefits, the fee that's being generated, that revenue is going to occur in the beginning, right away. So you can have benefits and costs that occur at different points in time. That's why when we do cost benefit analysis, we need to focus on the present value of those benefits and those costs. Because when we're comparing that senior center and that recreation center, we need to make sure we're comparing apples and apples. We need to make sure that the costs and the benefits that we're getting in the senior center are being compared equally to what we're getting in the recreation center, even though some of those benefits in the recreation center may not accrue for several years. So that gives us this thing known as discounting and compounding. So if we want to take a future value and we want to convert it into how much it's worth today in a present value, we're doing discounting. If you want to take the present value of something and know how much it'll be worth in the future, then you're doing compounding. So an example here is for discounting is if we know we're going to get this future value of benefits at some point in time in the future. In order to make a sound budgeting decision today, we need to take that future value and we need to discount it back to how much it is worth today. Another really simple example is if I gave you $1,000 on January 1st, or I give you $1,000 the following December 31st. The $1,000 I give you on January 1st is worth more because you can take that $1,000 and you can invest it at prevailing interest rates. And so that by December 31st, you'll have more than $1,000, hopefully if you've invested it well. So we have to take into account that changing value of money and the opportunity costs that are associated with not getting money or not getting a benefit today and having to wait to the future to get that benefit. So if you want to take a future value of a benefit and you want to discount it back to the present value, the very simple formula is future value divided by 1 plus the prevailing rate of return raised to n, which is the number of compounding periods. And so, if you can take that money, you can invest it at a 5% rate that compounds twice per year, 1.05 raised to the second power squared, divide that into your future value, that will then give you the present value of those benefits. So we have to always remember this impact of time on the value of money through this discounting process. So we have to identify our goals and objectives, identify our benefits and costs, discount the monetary value of those benefits and those costs in order to properly do the cost-benefit analysis. Now, at the end of the day, with our cost-benefit analysis, the primary statistic, if you will, that we use is what's called a benefit-cost ratio. And the benefit-cost ratio is the present value of the benefits divided by your present value of your costs. Idea being that if benefits and costs are equal, your benefit cost ratio, your BCR, will be 1. Anything that is over 1 means your benefits are exceeding your costs, and so it makes it more fiscally viable than something that is less than 1. You want your benefits to at least exceed your costs. So we can go through a cost benefit analysis for a senior center and for a recreation center. And ostensibly, if our senior center has a benefit cost ratio of 1.3 and our recreation center has a benefit cost ratio of 1.1, then we probably would lean more toward the senior center, given the fact that money is available for that senior center. And again, the BCR stands for a benefit cost ratio. It's the net present value of your benefits divided by the net present value of your cost. And that benefit cost ratio, that BCR, is the typical tool that we use in our cost benefit analysis to compare between different courses of action. Oftentimes, we'll use that cost benefit analysis to compare between 2 different capital projects, like our senior center and our rec center. But again, the cost benefit analysis is a supplemental tool at best, because not everything can be distilled into a monetary value. And we don't always know what all the future benefits will be. Sometimes we are surprised and we get additional benefits or different types of benefits from a course of action that we didn't really forecast in the beginning. But it's a good supplemental tool that we can use in budgeting to choose between different courses of action, oftentimes between different capital projects. Now, another reason why we use analysis is for the purpose of fiscal solvency. And we're going to get to that in just a second. But what I'd like to do is talk about accounting now and get into financial reports and annual financial reports, because we're going to use that annual financial report then to then assess our fiscal solvency. So do accounting now, and then we'll return to fiscal solvency in just a couple of minutes. So the sister to analysis is accounting. And we have a unique approach to government accounting that is somewhat different than what we do in the private sector, and also somewhat different than we do in the nonprofit sector. Obviously, the whole purpose of accounting is so that we can hold people accountable for how money is being spent, make sure money is being spent in the legally mandated way, and hopefully to see that we're spending that money in the most expeditious and most efficient way possible. In governmental accounting is predicated on 2 primary principles: fund-based accounting and accrual-based accounting. And we'll talk about each of those in turn. But these principles are safeguarded by an organization known as GASB, the Government Accounting Standards Board. And the Government Accounting Standards Board follows GAAP, the generally accepted accounting principles, but also has some nuances that are specific to the public sector. And every now and then, every few months, GASB will issue a statement. Those statements then provide guidance and requirements for state and local governments in how they need to do their accounting. And I'll give you a couple of examples of those as we go through our discussion here. But GASB is primarily responsible for overseeing these 2 main principles of governmental accounting, known as fund-based and accrual-based accounting. Fund-based accounting says that we will segregate government money into different discrete funds. We do that so that we are not double spending money, and so that we can ensure that that money is being spent in the way in which it is legally required to be spent. We segregate money into different funds based upon either where the money is coming from or how the money must be spent. So those are the 2 basic criteria: where the money is coming from or how the money legally must be spent. And we use those 2 criteria to then determine which fund to place those monies in. In fund-based accounting, there are basically 3 main types of funds. The first type or category of funds, what we call governmental funds. Examples of governmental funds are the general fund. The general fund is usually the largest fund that a government has. And that general fund typically consists of mostly unrestricted money. Now, governments, local governments will have a pot of unrestricted money and pots of restricted money. Unrestricted money can be spent in, however the government needs to spend it for its daily operations. Restricted monies can only be spent on certain types of things, and you cannot double spend, and you cannot use restricted money for purposes other than what the restricted money is intended for. So most of your general fund is going to be unrestricted. Now, not all of it, some of it will be restricted, but the majority of it will be unrestricted. The general fund is what governments tend to use for their daily operating processes. And so as a local government, you're going to have, not really unfettered, but you're going to have pretty flexible types of rules in terms of how general fund money can be used. Salaries oftentimes usually come directly out of that general fund. Supplies will come out of that general fund. But again, it keeps your government running on a daily basis. A second type of governmental fund is a special revenue fund. Special revenue fund is for oftentimes things like special taxes, or if you create an assessment district, that money goes into a special revenue fund because it's being captured from a specific source for a specific purpose. So again, a good example of that's an assessment district. And so if we want to install streetlights in one of our neighborhoods, instead of charging the entire city a higher tax rate to pay for those streetlights in that one neighborhood, we will take that neighborhood and make it into an assessment district. That assessment district then will get a higher tax rate to pay off those streetlights that we're installing in that neighborhood. Why? Because the neighbors who live in that neighborhood are the ones who use those streets most frequently, so they're going to derive much more of a benefit from new streetlights than someone who lives across town. So we create an assessment district. We then charge a higher incremental tax rate to those people in that district. We then capture that money. We put it in the special revenue fund for the purpose of then paying off those lights. So that's an example of a special revenue type of fund. Obviously, you're more limited in terms of the money that goes in and comes out of that special revenue fund. You can't use it unfettered for any purposes you want. You have to use it for those specific types of purposes coming from a specific type of source. Another type of governmental fund is what's called a debt service fund. Sometimes debt service funds are referred to by governments as sinking funds. And so sometimes you'll see them called debt service. Sometimes you'll see them called sinking funds. But a debt service or a sinking fund is just what it sounds like. It's money that's used for the principal and interest payments on debt that's been incurred by that government. So whatever you're using to repay that debt is in that debt service fund. And again, it's limited to go to pay off that principal and that interest. Another type of governmental fund is a capital project fund. So if you've got some capital projects going on you need to pay for, you take that money, you put it in your capital projects fund. So you issue debt, you float a bond, you get proceeds from that bond to construct a new senior center. That money will then go into that capital projects fund, and then as you build the senior center, you pay for it out of that capital project fund. Again, you don't want to commingle your funds. So those are just examples of what we call governmental funds, because they go to general governmental operations. A second category of funds are what we call proprietary funds. One example of proprietary fund is what's called an enterprise fund. An enterprise, a public enterprise, is something that generates revenue. It's something that may generate a profit. So if you're operating a public utility, that's going to be considered to be a public enterprise. When I was on the school board, we operated a child care program, and we called it the Child Development Program, the CDP. The CDP was an enterprise, and so all the money that was generated through that Child Development Program would go into the enterprise fund. We called it fund number 63. So the general fund was fund number 01. Enterprise fund, that CDP fund, was fund number 63. We had a capital projects fund, which I believe was fund number 10, if I'm not mistaken. So all your funds have different numbers depending upon which fund you're looking at. So for this enterprise fund, this is money that is being generated through the operation of some public enterprise. Idea being that that money that's being generated is being generated for the maintenance and continued operation of that enterprise. So that money that was generated from the tuition that parents paid to have their kids in the child development program was captured within fund number 63 to be used for the continuing operations of the child development program. So it didn't go in the general fund. It wasn't for use by the district. It was for the child development program. Now, the district could borrow that money. So the district had a shortfall in its general fund. It could borrow money from Fund 63, but it had to be repaid according to our board policy. You should only borrow up to $1 million, and it had to be repaid within 6 months of borrowing. So it always has to go back in because it's for the maintenance and the development operation of the enterprise that generated the money. Another example of proprietary fund is an internal service fund. And so sometimes you'll have some agencies that support other agencies, and that money that's going to support other agencies will be in what's called an internal service fund, again, segregated away from your general governmental funds. Third category of funds are what are called fiduciary funds. Now, these are kind of a strange type of animal in that a fiduciary fund, the government does not own that money. The government is controlling that money, is managing that money, but doesn't necessarily own the money. So an example of something like that could be a pension fund, post-employment benefits fund. A lot of governments call it post-employment benefits. That's a pension fund. That money in that post-employment benefit fund, that money is for people who are retired and people who are retiring. It's their money. It's just being managed in this pension fund. Trust fund. And so we have certain types of excise taxes, like a motor fuels excise tax. That money goes to construction and reconstruction of the roads and the highways. And so it's already spoken for. That goes into a trust fund, and the government's just operating in a fiduciary capacity, managing that money, hopefully not losing it, but it's money that's going directly to construction and reconstruction of roads and highways. There are fiduciary funds called interagency funds. Sometimes you'll have situations where you have federal grants and aid, and those federal grants and aid will be going to a local government, but they must first pass through another government. So they must first pass through the state government, or it must pass through a county government before they get to the city or the school district. Well, as that money passes through, the state or the county doesn't own that money. It doesn't belong to the state or the county. The state or the county may be able to charge an indirect administration fee, so maybe like a 1% fee or something like that, but that money does not belong to that government. It's just holding it and managing it as part of the grant language to then give to that other local government. So that would then go into that interagency type of fund. Again, a lot of those pass-through types of grants go into interagency funds. But again, the whole idea is just to segregate money to make sure that it's being spent on what it's supposed to be spent on, and we are not double spending money. We are not spending money where we're not supposed to spend it. That's what's known as fund-based accounting, a basic requirement of governmental accounting. Then there's a second principle known as accrual-based accounting. The basic dichotomy is between cash-based and accrual-based accounting. So those are your two basic types of accounting methods. Cash-based accounting is something that we are familiar with in our everyday lives. And so we count revenues, receipts, as revenue when we receive them. And so in your normal everyday life, whenever your paycheck goes into your bank account, you consider that to be revenue. That's your receipt whenever it goes into your account, whenever you actually physically have received it. You consider an expense or a disbursement whenever the money is being spent. So whenever you sit down and you write the check, or you go into your electronic bill pay and you make that payment to the utilities or whatever it is, whenever you write that check, then that's considered to be an expense or a disbursement. And so it's when that money is changing hands in a cash-based system of accounting. In an accrual system of accounting, you've got a little bit more flexibility in terms of when you consider something to be revenue and when you consider something to be an expense or an expenditure. Governments tend to use a type of accrual-based accounting known as modified accrual accounting. The way modified accrual accounting works is that revenues are considered as revenues when they are measurable, collectible, and available. So to give you an example, if a local government has a fiscal year that runs from July 1st until June 30th, it has property tax revenue that is scheduled, we're just making this up, scheduled to come in on July 15th. July 15th falls into the next fiscal year. Under a cash-based system, the government would not be able to consider that as revenue until they actually receive it on July 15th. That would be in the next fiscal year. Under modified accrual accounting, the government can consider that to be revenue in that preceding fiscal year. Even though they don't collect it till July 15th, they can consider it to be revenue in June because it's measurable and it's collectible. They know exactly how much they're going to get. They know that they are going to get it. It's very collectible. It's available. It just hasn't come in yet. So in modified accrual, that can be considered revenue even though it has not yet been realized. It has not yet come into government coffers. Under modified accrual, expenditures are considered to be expenditures whenever a liability is incurred. So whenever you order something and you get the bill, they come into your inventory and you have a bill that needs to be paid, you've incurred a liability, even though you haven't written the check yet, it can be considered an expenditure when that liability has been incurred. Because once you've received it, the inventory, and you are owing that money to someone else, you are legally obligated to spend that money. It's a legal liability. So as you can see, you kind of have a little blurring of the lines with modified accrual in terms of when you consider revenues as revenues and when you consider expenditures as expenditures. Then the most extreme example of accrual accounting is what's called full accrual accounting. Full accrual accounting really blurs the lines. I mean, that in full accrual accounting, revenues can be posted when those revenues are earned, not necessarily when they come in to government coffers, not even when they're measurable and collectible. So in full accrual accounting, if you were going to use that method of accounting in your government, you could count, if you don't have money coming in until September or October, you could still count that as revenue against your preceding fiscal year. It's a much more flexible type of rule in terms of when you can consider revenue as revenue. And expenses are considered expenses whenever the good or service that's being purchased is used up. So whenever you consume that good or that service, even though you haven't paid for it yet, that's when it's considered to be an expense. Now again, governments use modified accrual accounting for almost everything, but not for everything. The exception is for enterprise funds. For governments and their enterprise funds, you are required to use full accrual accounting, and then you use modified accrual accounting for all of your other funds. That's a change from GASB. It's GASB Statement 75, where GASB requires that you account for your enterprise funds under full accrual accounting. What that has meant is that now when you read the audit for an enterprise fund, you may see that their assets greatly outstrip their liabilities. And the reason for that is that GASB requires that you include the value of your capital facilities within your assets of your enterprise fund. So whenever we would look at the audit for our child development programs, people would always say, oh my gosh, the child development program has a balance of $50 million. Well, no, they don't. Those assets are the value of their capital plant, the value of their buildings, the value of their physical plant, because that's what's required to be included in your assets under that GASB statement. It has to be full accrual accounting, but all the rest of what you do in government tends to be done on a modified accrual type of basis. Let me give you an example of why this makes a difference. And so here's a very simple example to try and illustrate it a little bit. Let me move my boxes out of the way. So let's say, for instance, a city is going to have a fireworks show. So the city orders the fireworks, and the show is scheduled to be held on July 4th, as a fireworks show would be held. Its fiscal year runs from July 1st until June 30th. So the city goes ahead and orders the fireworks on May 21st. The fireworks arrive in the city inventory with an invoice to be paid on June 15th. The fireworks show occurs on July 4th, and the city then writes a check and pays for the fireworks on July 10th. Under a cash-based system of accounting, that would be considered to be an expense or a disbursement on July 10th when the check is written. So when they write the check and they send the check off to the fireworks company under cash-based, that's when that would be considered to be a disbursement or an expense. Under modified accrual, it's considered to be an expenditure, and the language is a little bit different. In modified accrual, we call them expenditures. Under cash-based and full accrual, we usually call them expenses or disbursements. But in modified accrual, it's an expenditure when it becomes an account payable on June 15th. So whenever those fireworks arrived with that bill, we've now taken possession of the fireworks. We now have a legal obligation, a contract that we have to make good on. We have to pay for those fireworks. So on June 15th, under modified accrual, that's when it's considered to be an expenditure. Under full accrual, it's not considered to be an expense until the good or service is used up. So on July 4th, we shoot off the fireworks are consumed. When those fireworks are consumed, that's what's considered to be an expense. So the so what question is, under a cash and full accrual system, the expense would occur in the next fiscal year. For cash base, it would be on July 10th. For full accrual, it would be on July 4th. However, for modified accrual, it would fall under the previous fiscal year, because it would be counted as an expenditure on June 15th. So you would have to count that as an expenditure in your previous fiscal year. So it does make a difference, as you can see when you're dealing at those margins about when you consider something an expense or an expenditure versus when you do not. So we use both fund-based accounting as well as modified accrual accounting as our government accounting principles. We also, in government accounting, are required to maintain scrupulous documentation of the money that we are spending, the purchases that we are making. So there's another principle in accounting known as double entry accounting. And this is true across all sectors. In double entry accounting, you have two entries for every single expenditure. Every purchase you make, you have two entries. First, you'll enter it into what's called the journal. The journal is a chronological listing of all your purchases and transactions, listed in chronological order. Then all of those purchases from your journal will then also be entered into your ledger. And the ledger is where you will group all your purchases by account or by category. And again, we do this double entry accounting for the obvious purpose of trying to avoid double spending of money. If we enter it in two different places, then it's a better protection against the double spending of taxpayer money. We are required as well to produce documentation in the form of financial reports. Now, some governments will produce quarterly financial reports. Some governments will produce just a comprehensive annual financial report. What we are going to be concerned about in this class is the comprehensive annual financial report, because that's going to be much more common to see in governments, especially at the local level, than quarterly reports. So this comprehensive annual financial report, or annual comprehensive financial report, however you'd like to term it, is again that retrospective document that tells us what money we spent in the preceding fiscal year and how we spent that money. But it gives us a lot of additional information even beyond that. Your typical financial report, annual financial report, again, as I said, is going to be 200, 300 pages long. It will consist of four main sections. There will be an introductory section. In an introductory section, the city will tell you about all the awards they've won for their scrupulous accounting standards. They'll tell you about the city, the organization structure of the city, some little history of the city. You'll have all that in your introductory section. And then the part that really most people focus on is the management discussion and analysis. Several years ago, GASB passed this statement called GASB number 34. And Gatsby Statement 34 required that all financial reports must have a management discussion and analysis section. And the purpose of the management discussion analysis section was to provide an easy to consume narrative for citizens to better understand all the information that was being presented in the annual financial report. So if you want to get a real quick idea of what the fiscal picture looks like in that city, read the management discussion and analysis section. If you're a numbers person and you want to get into all the balance sheets and the balancing sheets, that's when you get into the third section known as the financial section. The financial section will have balance sheets broken down according to fund, and so you'll have revenues and expenditures listed out for all of your different governmental funds, all your different proprietary funds, all your different fiduciary funds. You'll also have it broken down in assets and liabilities, and so the owned items of the government versus the claims against those owned items. So your assets are your owned items, your liabilities are your claims against those owned items. They will also give you some combined, what they call balancing sheets, where they'll give you a combination of all revenues and expenditures across all your different fund categories and assets and liabilities across all different fund categories. All that information, all those tables are found in the financial section. You'll probably notice in your financial report a lot of notes. Anything that needs to be explained in the financial section that doesn't fit within the table will be in a note. And so sometimes you'll see hundreds and hundreds of notes listed there explaining a lot of the nuances that couldn't be explained in your financial section tables. But all of your numbers, assets, liabilities, and revenues, expenditures, find all of that in the real guts of the financial report, which is the financial section. Then the fourth part of the financial report is what's called the statistical section. The statistical section is very useful at showing you trends. And so in the statistical section, they will show you what's happened to their population over the past decade. They'll show you what's happened to their property tax base, the assessed valuation of property over the past 10 years. They'll show you patterns in terms of commercial and industrial locations. So they'll show you if they've had industries moving in and out of the city over the past 10 years. They will show you a demographic profile of the city over the past 10 years as well. All that information that gives you those past 10 years and all that pattern, all that trend data, you'll find all that in the statistical section. The statistical section is actually a lot more useful than a lot of people think, because it does give you a really nice overview of some of the longitudinal trends that have been going on in the city over the past several years. Now, because we do have such limited time tonight and overall in this class, I have provided you with a copy of the Long Beach Comprehensive Annual Financial Report. I believe it's from 2019. And I've also provided you with, on the Beach Board side, a video of how to read a comprehensive annual financial report. It's a brief, I think about 20-minute video. It takes you through all the different sections of the annual financial report and shows you different things to look at in each one of those different sections of the annual financial report. So I do recommend that you go through and watch that video and then get the CAFR, the Comprehensive Annual Financial Report for your city. Look through that, pay attention to the management discussion and analysis, and then after we take a break tonight, we're going to come back and talk about fiscal solvency indicators. And some of those fiscal solvency indicators that you're going to be using, you will get from the financial section of the Comprehensive Annual Financial Report. So if you want to know information about revenues, expenditures, you want to know about intergovernmental revenue, you want to look at property tax revenue, you want to look at their debt burden, things such as that, you'll find a lot of that information in that financial section, and those are all indicators you can use then to assess fiscal solvency. So again, I don't want to get into fiscal solvency right now because we've been at it for quite a while. It's 7:20. So why don't we say, let's take a 10-minute break. If a 10-minute break is good for everyone tonight instead of 15, let's do a 10-minute break. Let's come back at 7:30, and then I will share with you the Brown 10-point indicators and the Dennis Wang and 2 indicators of how we assess fiscal solvency. We'll talk through those and how you find those in the financial report, and get you ready then to do beach board exercise number 3. And then we'll assess our time and see how we are doing. If we have enough time left, we may get started on capital budgeting and then may have to leave debt management till next week. But we'll see how we do on time. So go ahead and take about a 10-minute break. Come on back at 7:30, and we'll talk about specific indicators of fiscal solvency. All right, it's 7:30, so we are back. Make sure I'm recording still. Okay. What I thought we'd do now is, again, I want to introduce you to some of the different ways in which you can assess fiscal solvency of your city. And then, again, for beach board number 3, you'll be getting the financial report, and then using maybe 2 or 3 of these. I'm not expecting you to use them all, obviously, but to try your hand at using 2 or 3 of these ratios to assess fiscal solvency in your city. Now, the first one I'm going to show you is what's called Brown's 10-point test for fiscal solvency. And the way in which this works is that, and I'm not expecting you to go and do all of this, but the way in which it would normally work is that if you want to assess the fiscal solvency of your city, you would select comparable cities. And so you select a handful of other comparable cities, and then compare your city on these different ratios to those comparable cities. And so what would happen is, for each one of these different indicators, you would calculate the ratio for your city and then calculate that same ratio then for your comparable cities. And then you array them in quartiles. And so, your top 25%, your bottom 25%, and your middle 50%, you array them in the quartiles based upon the ratios, and then you assign a point value to each one. And so if your city is in the bottom quartile, it's in the bottom 25% on this ratio, this given ratio, it would get a score of -1. If it's in the second from bottom 25%, it would get a score of 0. If it's in the second highest 25%, the second highest quartile, it would get a score of 1. And if it's in the top 25% on that ratio, it would get a score of 2. And then you would add up all the scores for your city across all 10 of these indicators. And if you had a city that scored a 20, it means it was in the top 25% on all 10 of the indicators. That would be an extremely strong indicator of fiscal solvency compared to other comparable cities. So all of this is done relative to other comparable cities. Now, I'm not going to ask you to go and put together a sample of comparable city. All I'm going to ask you to do in beach board number 3 for fiscal solvency is select 2 or 3 of these indicators, either the Brown indicators or the next set that I'm going to show you, calculate those ratios and report those ratios for beach board number 3. And that's all I'm really going to ask you to do. You don't have to go and get the information for other cities as well. But just know that if you're actually doing this in the real world, you would calculate these ratios not just for your city, but also for other comparable cities. So in Brown's 10-point test, he provides us with several different indicators of fiscal solvency across a variety of different categories. So for some of these indicators, they're what he calls revenue indicators. Some of them are, one of them is an expenditure indicator. 3 of them are what he calls operating position indicators. 2 of them are debt indicators, and 1 is an unfunded liability indicator. So for each one of these, what you're doing is you're going to create a ratio. So your first one is total revenues per capita. Easy ratio to calculate. You take your total revenues for all your governmental funds, not including capital projects. So you don't include your capital project, but all the revenues for all your governmental funds, your general fund, your special revenue fund, all governmental funds except the capital project fund, and divide that by the city's population. So it gives you an idea of the amount of revenue per person in the city, per capita. Obviously, the larger the amount of revenue per capita, the more fiscally healthy your city is. The second indicator is also a revenue indicator, but it focuses only on intergovernmental revenue divided by your total revenue. So your intergovernmental revenue that comes from other governments, divide that by the total general fund revenue your city is generating, gives you this intergovernmental revenue, total revenue percentage. The purpose behind this one, obviously, is that the more reliant your city is on intergovernmental revenue, the more susceptible they are to lack of control. Because if you're getting a good percentage of your revenue, if you're getting a 40, 50% of your revenue from the federal government or from the state government, you don't control directly federal or state government grants. That's out of your control. And so the more of your revenue that's out of control, the less promising it is, if you will, for your fiscal solvency. Here's another revenue indicator, a ratio of property tax or own source revenue, tax revenues divided by total revenues. So a percentage taking your total tax revenues levied locally in the general fund. Now, for a lot of cities, that's going to be primarily property tax revenues. If you're heavily dependent upon the property tax, you divide that then by your total general fund revenues to see, again, how reliant you are on your own revenue for fiscal stability. So it's kind of the inverse of the intergovernmental revenue purpose. Then your fourth indicator is an expenditure indicator, kind of like your first one, but this one's for expenditures, total expenditures per capita. Then your next three are what are called operating position indicators. And so your operating surplus or deficit divided by operating revenues. So you take your surplus and you're looking at your operating surplus in your general fund. So this is the general fund surplus divided by your total general fund revenues. Obviously, if you have a deficit, you're using deficit as your numerator. You would put a negative sign in front of it to denote that it's a deficit. But again, that would help you compare to other comparable cities. So you're not comparing, so you have a huge deficit, then you might compare as favorably to a city that has a huge surplus. So you got to indicate it somehow. So you indicate it with a negative sign. But again, this gives you an idea of your current operating position, surplus versus deficit in comparison to your overall general fund revenues. A second operating position indicator, general fund balance divided by general fund revenues. So your unreserved fund balance in the general fund, so your fund balance that has not been set aside for anything else, divided by your total general fund revenues. And a third operating position, your enterprise fund working capital coverage percentage, which is basically the current assets of your enterprise funds divided by the current liabilities of those enterprise funds. That's going to, again, be in this financial section of your comprehensive annual financial report. You look at the balance sheet for your enterprise funds, just divide your assets by your liabilities for those enterprise funds. Then your next two are debt indicators, long-term debt divided by assessed valuation percentage. This is your long-term general obligation debt divided by your assessed value of your property. Now, this one you're probably going to find easiest in your statistical section of the CAFR. So for this one, you might want to move into the statistical section to do this one. Another debt indicator, your general obligation debt service. And so the money that you are paying to maintain your general obligation debt, and we'll talk about what general obligation debt is either later tonight or next week. That divided by your total general fund revenues. So it kind of tells you your indebtedness compared to the amount of revenue that you are bringing in. And then your final indicator from Brown is the post-employment benefit assets divided by liabilities percentage. So you take your funded ratio, the actuarial value of your plan assets. You're going to take the actuarial value of your plan's assets divided by accrued liability. This just kind of gives you an idea of how stable your pension fund is, how stable your post-employment benefits are. That's one a lot of people don't use because it's kind of a little bit more of a nuanced one as compared to the more general and easier to calculate ones such as revenue per capita, expenditure per capita, surplus divided by revenue. Those are all pretty straightforward, pretty easy to calculate ones that you can find very readily in your financial section for your information on revenues and expenditures. And then for information on population, you may then have to go into your statistical section. Some CAFRs will actually report this information for you in the management discussion and analysis. It depends on how user-friendly your CAFR, your city has decided to be with its CAFR. But again, anytime you need to find population, you can find the population in the statistical section, and then information on revenues and expenditures and information on assets and liabilities, you will find then in that financial section. So sometimes you're going to have to mix and match between looking in the financial section and looking in the statistical section. So those are 10 indicators known as Brown's 10-point fiscal solvency tests. Then another approach you can use comes to us from Wang, Dennis, and Tu, the Wang, Dennis, and Tu solvency test. Kind of a similar type of an approach in that it's also based upon ratios. And usually when you are calculating fiscal solvency, you're going to be, by definition, calculating ratios, but they use some different categories for their ratios. So for Wang, Dennis, and Tu, they have ratios on cash solvency, ratios on budget solvency, ratios on long-term solvency, and ratios on what they call service solvency. So the first one here, a cash solvency indicator known as cash ratio. You take the amount of cash the city has plus the city's cash equivalents. Cash equivalents are assets that can be liquidated very, very quickly and turned into cash. So something that can be turned into cash very quickly is a cash equivalent, plus investments that can be liquidated, be turned into cash relatively quickly, divided by your current liabilities. This kind of gives you an idea, again, of how solvent you are from a cash on hand type of perspective. Then the second one, which is also cash solvency focused, is what's called the quick ratio. It's cash plus those cash equivalents, plus investments, plus receivables. Receivables will be monies that you are owed, monies that will be coming in the near future, divided by your current liabilities. So the only difference here is you're adding in those receivables, those amounts of money that you'll be getting in the very near future. Another cash solvency indicator is what's called the current ratio. It's just current assets divided by current liabilities. Again, that's very easily found in your financial section of your CAFR. Then we go into the budget solvency indicators, and there are two of those. One budget solvency indicator is your operating ratio, total revenues divided by total expenses. Very easy to calculate. Again, very easily found, not only in your financial section, but you can probably also find this in your management discussion and analysis section. Your surplus or deficit per capita. So you take your total surplus divided by your population. Again, here you're going to have to use your statistical section to get your population. Then we move into what's called long-run solvency indicators. One of these is what's called the net asset ratio indicator. Your restricted and unrestricted net assets divided by your total assets. Long-term liability ratio, your long-term liabilities. And so by long-term, we mean liabilities more than 1 year in duration. So short-term will be 1 year or less in duration. Long-term will be liabilities beyond 1 year, liabilities you'll owe beyond 1 year in duration. So those long-term liabilities divided by your total assets. Long-term liability per capita, take your long-term liabilities, more than 1 year, divide by your population. Tax per capita, your total taxes divided by your population. So add up all the taxes, divide it then by the population of the city. And then ones we're familiar with, revenue per capita, total revenues divided by population, and expenses per capita, total expenses divided by population. So here you have, with Wang, 2, and Dennis, you have 10 different indicators you can select from. With Brown, you have another 10 indicators you can select from. So what I would like for you to do on Beach Board essay number 3, after reviewing your city's annual financial report, of these 20 different indicators, pick 2 or 3 of those, calculate those for me, just kind of as a real quick snapshot of the fiscal solvency of your city. Again, now that we know these different indicators, we can do a more nuanced job of talking about fiscal solvency as compared to just saying, well, the revenues exceeded the expenditures. And on the vast majority of the pre-instructional, most folks said, I don't have the information yet to answer that question on fiscal solvency, which again is absolutely acceptable. A few people did answer fiscal solvency, and for those who did, most just said revenues exceeded expenditures, so therefore the city is fiscally solvent. Here you've got some more indicators you can pick from in assessing the fiscal solvency of your city. So you'll be doing this for Beach Board number 3, and then you'll be doing it again on the post-instructional in part 1, re-answering that question on fiscal solvency. And then hopefully once you do that, you'll then, once the class is over, be able to go back and look at how you answered or didn't answer fiscal solvency on the pre-instructional, and then how you answered on the post-instructional, and actually see that you're better able to assess that fiscal solvency as a result of the information you got from the class. This document that I'm showing you right now is available on our Beach Board site. It's under week 3 documents. It's called, it's the McDonald file. It's McDonald PDF. And these tables, as you can see, are available starting on page number 5 for the Brown 10-point indicators, and then page number 6 for Wang, 2, and Dennis. So feel free to use that as your resource then in doing your Beach Board essay number 3. So at least now we have, in terms of analyzing fiscal solvency, we actually have some indicators we can use to look at the fiscal solvency of our city. Now, as I said before, if you were doing this in the real world of budgeting, you would take these ratios, calculate them, and then compare these ratios to comparable cities. I'm not going to ask you to do that. Just calculate 2 or 3 of these indicators for your city that you have chosen to analyze. Okay. Typically, I usually talk about fiscal solvency as we talk about analysis, but because we're running a little bit long, I did want to give you a break, and so that's why we kind of did that after our break. But since it is 7:47, we have some time left. I think what we'll be able to do then is to introduce the topic of capital budgeting in the second half of class here tonight. And then we'll probably have to hold off on debt management until next week. We'll see how we progress. But up until this point in time in the class, we have been talking primarily about the operating budget. Most governments, especially at the state and the local level, will be able to maintain 2 separate budgets, and they choose to maintain 2 separate budgets. They'll maintain an operating budget used primarily for the day-to-day functions of the government, and then they'll use a capital budget. And the capital budget will then be reserved for funding capital projects. Now that's at the state and the local level. At the national level, the national government does not maintain a separate capital budget. The national government puts everything together into the national budget, regardless of whether it's an operating expense or if it's a capital expense. But at least at the state and local level, we use these separate capital budgets. So why do we use these separate capital budgets? Because capital projects are fundamentally different than operating projects and operating expenses. Capital projects tend to have very long lifespans. And so we're talking about things such as constructing a building or purchasing a new fleet of police vehicles. They're going to be with us for hopefully decades. So they have very long lifespans. There are also projects that have very high price tags. If you're going to construct a new school, if you're going to make a really nice elementary school, it's probably going to cost you in the range of about $60 to $70 million to construct that elementary school. The last elementary school that my district built was 12 years ago, I want to say, about 11 or 12 years ago. And at that point in time, it cost $55 million to construct that school. Now, that was a school with occupancy, a capacity of, I think it's 1,100 students, 2-floor school. Much more expensive now because of supply chain issues, cost escalation in some local governments has been upwards of 30 to 40%. So it's going to be a very high price tag for any new buildings that you're going to construct. And these capital projects are also non-recurring, in that once you complete them, you're not going to be doing them each and every year. So capital projects are fundamentally different than the types of things that we are funding within our operating budget. So it makes intuitive sense then at the state and the local level for us to separate these capital projects from our normal operating budgets. And we separate them then out into these capital budgets. Doing so helps us enhance and increase our efficiency. It allows us to use different decision-making models for those capital projects as opposed to the decision-making models that we use for our operating budgets. It also allows us to stabilize our tax rates. If we were going to just dump these capital projects into our operating budget at the state or the local level, that would lead to an exponential increase in the size of that operating budget. To then generate the revenue we would need to pay for all those projects, we would then need to have an exponential increase in tax rates in order to pay for those projects. So by segregating those projects into a separate capital budget and paying for those with debt, we're able to then space out the repayment over a long period of time. So instead of having an exponential increase in tax rates, we can have a much more modest and much smaller incremental increase in tax rates year to year. Again, we're using a different decision-making model with our capital budget, so it allows for us to plan for those permanent results. Where we may be able to get away much easier with incrementalism in the operating budget, when we get to the capital budget, we're going to want to be much more rational in nature. So we're going to want to use a more rational, comprehensive type of decision-making model as opposed to incrementalism. It basically is just a better management tool for us at the state and local level to maintain these separate capital budgets. That being said, the federal government, as I said before, does not maintain a separate capital budget. They dump everything together into their unified budget. One reason for that is that the federal government runs a lot of deficits. When they run a lot of deficits, they're not concerned about deficits because they do a lot of what's called counter-cyclical spending. You would think that the federal government will spend less money in poor fiscal times. So when the economy is not doing well, when unemployment rates are high, you would think the federal government would spend less money because there's less federal income tax revenue coming in. Fact of the matter, though, is you need to stimulate the economy. And you can stimulate the economy sometimes through tax breaks, but you can also stimulate the economy through spending. We saw this in the Obama administration with a lot of the reconstruction bills that came out in the Obama administration to help the economy recover from the Great Recession. The size of the federal budget is absolutely immense. And so the size and scope of the federal budget is so large that throwing a $100 million project into the federal budget is not going to really even be a ripple in a pond. If you throw a $100 million capital project into a local budget, you're going to blow that budget out of the water. And the federal government doesn't worry about deficits. It doesn't worry that much because it doesn't worry about its credit ratings. The federal government has a very good credit rating. It typically, over the years, has been a AAA bond rating for the federal government. Standard & Poor's lowered that by half a classification a few years ago. But for the most part, people will continue to purchase national debt because it's seen as being very secure. It's seen as being very secure because the federal government has a lot more control over the economy than state or local governments do. We've got the Federal Reserve that can increase or lower discount rates, which you just recently saw them increase discount rates to try and slow down inflation. The Federal Reserve can change reserve requirements for banks. They can change lending requirements for banks, credit requirements. And so the federal government has a lot more control over the economy than state or local governments do. Also, Congress has the power of the purse, and Congress has the ability to coin money, something that is not a power given to state and local governments. And so people will always purchase national debt, and so therefore the national government's not terribly concerned about blowing their budget with capital projects because it will not hurt their credit rating. But since we do most of our work at the state and local level of government, it's important for us to understand the capital budgeting process because all state and local governments will maintain a separate capital budgeting process. The heart of the capital budgeting process is the creation of this thing called a capital improvement plan. And I provided an example of a capital improvement plan, a facilities plan on our website for you to take a look at. The capital improvement plan will be a 5-year plan whereby we will schedule out all the different capital projects that we plan on constructing over the next 5 years. We will conduct a needs analysis, an inventory analysis, and then we'll schedule all those projects. Clearly, this is also a statement of priorities. Just like the operating budget is a statement of societal priorities, the capital budget is also a statement of societal priorities. So if a renovation of our storm sewer system is in year 1 of the capital improvement plan, and the senior center is in year 5 of the capital improvement plan, we can see where the priorities of the city are at. Priorities will be on renovation of that storm sewer system because that's a catastrophic failure there would certainly be catastrophic for the city. Whereas the senior center can probably wait for a few years. So it's very much, this capital improvement plan is very much the statement of priorities in prioritizing project against project. In constructing the capital improvement plan, we will engage in cost-benefit analysis. We will not only analyze each project in comparison to other projects, we'll also do a year-by-year analysis of available revenues and then the expenditures that will be needed as a result of pursuing these capital projects. The problem we sometimes run into in doing this analysis is that at times we will have things like federal matching grants, where the federal government will have a vested interest in a city constructing a senior center. And so the federal government will come in and provide a matching grant, telling the local government that we will match you dollar for dollar. Every dollar you raise to build the senior center, we will match it dollar for dollar up to a maximum of $50 million. But what that obviously does is it immediately lowers the cost of that senior citizen center. By lowering the cost of that center, you are then going to increase the resulting size of your benefit cost ratio, which then makes that senior center have a better benefit cost ratio than any other project, which will probably then push it up on your capital improvement plan. In the city in which I live in, several years ago, they constructed what they called a cross-valley connector to connect one side of the city to the other side of the city. They did that without borrowing any money because they were able to get federal transportation funds to pay for over 50% of the cost. So over 50% was paid for by the federal government. The remaining amount was paid for through the reserves that the city had been accumulating for several years. Clearly, if the federal government's coming in and paying for half of the project, that moved that project way up on the capital improvement plan, moved it way up on the list of priorities, and got it done a lot quicker than a lot of other projects that were vying for inclusion in that capital improvement plan. So you put together this capital improvement plan, you compare projects to projects in the cost-benefit analysis. As you compare capital projects to capital projects, there are several factors that you can analyze in ranking your projects. One factor you'll analyze in doing this project-by-project analysis is to analyze the capital as well as the operating cost for that facility. Now, a lot of folks think about the capital cost, the construction cost, but they don't oftentimes think about how much will it cost to continue to operate this facility year after year after year. You have to consider both capital as well as operating costs. Health and safety concerns. So what does the construction of this facility mean for the health and safety of the community? Clearly, a recreation center is probably going to fare very well in terms of those health and safety types of concerns. What types of impacts and effects will this capital project have on the economy? So if you're building a recreation center, it's going to be a government-owned and operated recreation center, and it's going to open down the street from a 24-hour fitness. That's going to have an impact upon the economy. It's going to have an impact on that 24-hour fitness. So what does it then mean for the people who work that 24-hour fitness? What impact is it going to have on the local economy? How about environmental and social effects? We have to do an environmental analysis for all of our capital projects. Here in the state of California, we have this thing called CEQA, the California Environmental Quality Act. And CEQA requires that whenever you're going to do a capital project, you must do an environmental impact analysis. Now, there is a waiver process that will allow you to avoid that analysis. And that CEQA waiver process is if you are constructing a facility that is going to replace the square footage that's already being used, so you're just replacing square footage with new square footage, then you can apply for a CEQA waiver. The catch, though, is that CEQA waivers are very expensive to put together. And I know in my district, we would spend tens of thousands of dollars for a consultant to put together a CEQA waiver to allow us to not go through the entire environmental impact analysis process. So even getting a CEQA waiver can be very expensive, but you have to consider environmental impacts. Disruption and inconvenience. And this is another one that sometimes cities overlook. How much and for how long will you have disruption from the construction of this facility? Are you going to have to close lanes on your roads? How long will those roads need to be closed? How much will you disrupt the lives and the economy in order to get this building constructed? The amount of support needed, especially infrastructure support. So if you're going to construct this new facility, you're going to have to tie it into your utilities. You're going to have to tie it into your sewer system. You're going to have to tie it into all of these existing types of facilities. That's why here in California, we have this process of creating not only assessment districts, but also creating these things called community facilities districts, or CFDs. The creation of a CFD is done to try and provide for some of this infrastructure support that new developments may need. And so we've got these CFDs that we create whenever a developer comes in and wants to develop a new neighborhood. They will enter into a mitigation agreement with the surrounding governments to try and mitigate the impact upon infrastructure supports. And so if building this new community means that you need a new fire station, that'll be part of that mitigation agreement. You may need to construct a new school to house those kids who are going to come from those new houses that are being built by a developer. Again, that'll be part of the mitigation agreement because you have to have these infrastructure supports in place. You have to consider the amount of risk that's involved. How much risk is there that this project will not get done or will not get done on time? Now, when you put together these contracts, you oftentimes will put together the contracts so that you will have penalties on these contractors if they do not bring the project in on time. And what are the consequences of not finishing? A lot of cities are dealing with that right now because of the incredible cost escalation that they have been facing through increased inflation and supply chain issues. As I said before, some local governments are seeing cost escalation on the capital projects of upwards of 30 and 40%. Well, if you originally approved, say, $30 million for this facility, and now this facility is going to cost you $55 million, what do? Well, you're going to have to go back and find that additional $25 million, or you're going to have to scale back your architectural plans to make it fit within your original $30 million, or you may not be able to complete the project. So what are the consequences of not finishing the project as you had originally intended to finish the project? This is a major problem, and we're not going to talk about debt right now, but this is a major problem whenever governments go out there and they issue debt to fund these capital projects. When that debt requires voter approval, when they go out there to get voter approval, they need to craft their ballot language very carefully to say exactly how this money is going to be spent. So if you say we're going to borrow $50 million to construct this facility, and this is what we're going to construct and how we're going to construct it, and then 2 years down the road, that facility is now going to cost $70 million. Well, we're just going to scale it back and not do everything we said we're going to do. Well, then you run afoul of your ballot language, and then you can be sued for not constructing your project in accordance with what you told your voters you were going to do. So it's kind of this slippery slope that a lot of local governments have gotten into because of all this cost escalation for their capital projects. So you have to take all these factors into account, and typically we're oftentimes going to use a cost-benefit analysis. In budgeting, especially for capital budgeting, we tend to use more cost-benefit analysis than we do cost-effectiveness analysis. If you had the policy class, the 670 class, you probably talked a lot about cost-effectiveness analysis. That's oftentimes much more applicable in the policy world as opposed to the world of public budgeting. As we construct these capital projects in our capital budget, we're usually going to do it through contracting out. And very seldom will we use government employees to construct these capital projects. So we're going to put out requests for proposals, RFPs, for contractors and subcontractors to come in and competitively bid on these capital projects. Here in California, public contract code is very specific and is relatively intricate as compared to public contract code in a lot of other states. If you're interested, public contract code actually is in government code 20100 all the way through 20929. If you know anything about government codes, you know that that's a pretty wide swath of government code, because there are a lot of regulations, a lot of requirements in competitive bidding. Depending upon the type of project and depending upon the type of local government that you are, your project may or may not be required to be competitively bid. If competitive bidding is required for this project, there are a couple of shortcuts that are allowed under California Public Contract Code to make the process a little bit more expeditious, if you will. One process that's allowed is what's known as piggybacking. And so what some governments will do is, I'll give you an example. So in my school district, we have 15 different schools, and so we are buying new playground equipment for all 15 different schools. We're not the first district in the state of California that's purchasing playground equipment. A lot of other districts have purchased playground equipment. They've already written their contracts for that playground equipment. So what the district was able to do under public contract code is to find a district that purchased similar equipment to what we wanted to purchase, take their contract, and then piggyback our purchasing on their contract. Essentially use the parameters of their contract to then go out there and do our competitive bidding. That's what's known as piggybacking. You're piggybacking your purchase on the contract that's already been used by another jurisdiction in the state to purchase a similar type of project. Here in California, we also have this thing known as the California Uniform Public Construction Cost Accounting Act, otherwise known as CUPCA. CUPCA does a lot of things in contracting, but one very useful thing it does is it has a provision for what's called pre-qualification in competitive bidding. In pre-qualification, what you can do is you can have a pre-qualification process whereby you can invite contractors to submit pre-qualification applications. You can then pre-qualify a whole pool of contractors, and then when it comes time to then assign contracts, you can then assign contracts to these pre-qualified contractors without going through the entire competitive bidding process. It basically allows you to vet contractors in advance and then have a whole pool of pre-qualified contractors you can use when it comes time to actually construct that project. But typically in competitive bidding here in California, what you will do is you'll put together a request for proposals. You'll then advertise that request for proposals, that RFP, and then contractors will then bid. In competitive bidding, they are sealed bids, and so you don't know where the bids are coming from, whose bid is what. The bids will come in a sealed envelope, and then you will establish a date and time whereby you will open those sealed bids. You open those sealed bids, and then under public contract code, you will award the contract to the lowest responsive and responsible bidder. So you must award the contract to the lowest bidder as long as that bid is responsive and that bidder is what's called financially responsible. So what does that mean? Well, a responsive bid is a bid that is responsive to all of the aspects of the request for proposal. So for a bid to be accepted, that bid must address all of the different parts of the RFP. So it can't leave any part of the project out. If it addresses all the required elements of the RFP for that project, then that bid is considered to be a responsive bid. The bidder, the contractor who puts in that bid, must also be considered to be financially responsible. You're considered financially responsible if you are bonded and if you are registered with the Department of Industrial Regulations, the DIR. So you are Department of Industrial Relations, the DIR. So you need to be registered with the DIR, and not only the contractor needs to be registered with the DIR, but all the subcontractors that the contractor will use need to be listed in that proposal, and they all also need to be registered with the state DIR. If any one of those subcontractors is not listed, or any one of those subcontractors is not bonded or registered with the DIR, then they could be considered to be not fiscally responsible, and that bid can then be rejected. If the lowest bid is deemed to be non-responsive, or if that lowest bidder is deemed to be non-fiscally responsible, and you reject that lowest bid, you'll then go to the next lowest bid. That lowest bidder can then have a bid protest, or really any of the bidders can then engage in what's called a bid protest. They can protest the awarding of a contract. They could say, well, you awarded this contract to a non-responsive bid, or you awarded to a non-responsible bidder, or they could say, the bid that you accepted, you rejected our bid, but we are responsive and we are responsible, whatever the case may be. They can protest that result in a bid protest, and then the government must then make a decision about whether or not to hear that bid protest. In my district, we had a couple of bid protests. Usually the bid protests were because the company that was issuing the protest felt that the lowest bidder that was accepted was either non-responsive or was not fiscally responsible. So again, it's a process that you go through competitive bidding, but most of these capital projects will be done through this competitive bidding process that's governed by California Public Contract Code. So it's a process to put together your capital improvement plan, and then that first year of your capital improvement plan will then become the capital budget for that given fiscal year. Some of the problems with capital budgeting and the capital improvement planning process. Number one, it needs continuous reappraisal. So you put together this 5-year capital improvement plan. Things will change over that 5-year period. And so you continuously need to reappraise and revisit the capital improvement plan. Some projects need to be moved up. So you may have a storm system repair, storm sewer repair that's scheduled for year 3. You have a catastrophic failure. You got to move that up until year 1. So it's a lot of revision, a lot of reappraisal. The decision of what to include in the budget is usually going to be governed by some type of a cost-benefit analysis, either a formal or an informal cost-benefit analysis. But cost-benefit analysis is really fraught with a lot of problems. We have cognitive limitations, and when we try and be as rational as we can be in a cost-benefit analysis, we're going to come up short. We're not going to be able to foresee all the costs and all the benefits. We may not be able to accurately monetize and discount all the different monetary values for those benefits and those costs. Some people will say that when we have a separate capital budget, that we really skew our decision making toward those projects where money is available. Again, the federal government swoops in with a federal matching grant. Chances are that's the project that's going to be funded, even if that project is not a top priority for the government. When you have federal matching grants, you oftentimes have a distortion of local spending preferences. And then some people say maintaining a separate capital budget really skews our decisions toward borrowing. That if we were going to put these capital budgets into our operating budget, we would think very long and hard about how necessary those capital projects are. However, whenever we are putting them in a capital budget and then borrowing money, it's much easier to borrow money than to decide what to cut in an operating budget. It's easier to borrow new money than decide how to make your citizens angry by cutting some of the programs that they rely upon. And so some people say a separate capital budget really does kind of push governments toward doing more and more borrowing. And I think there's some truth to that. I know that, again, my district passed a $148 million bond measure a few years ago. And because of some state funding, they've been able to leverage that into almost $200 million to spend on capital improvements. And so they funded some projects that they would not have funded if they had to pay for it from the general fund. In fact, they funded a lot of projects they wouldn't have paid for if it had come out of the general fund. But despite those problems, state and local governments will maintain that separate capital budget for those capital projects that have very high price tags, that are non-recurring, that really cut across multiple generations. Again, another issue for these capital projects is this thing known as intergenerational equity. And we usually fund our capital projects with debt for the purpose of intergenerational equity. The idea being that if you're going to construct a new recreation center, that recreation center is going to be with you for 40 or 50 years, people are going to benefit from it for 40 or 50 years. So is it really fair to make people in year one pay for all the construction costs of that recreation center, where people in years 2 through 50 are then going to end up being free riders, and they're going to benefit from it without paying those increased taxes? So that's why we usually fund our capital projects with debt and then extend that debt repayment over 20 or 30 or 40 years so that everyone in future generations using that facility will then also bear some of the burden. So you can eliminate that free rider type of problem. But state and local governments frequently almost always use capital budgets, whereas the federal government typically does not. So we've got this duality going on in budgeting. The operating budget for our daily, day-to-day functioning of our government, and then our capital budget to fund these capital types of projects. And as I said before, we fund these capital projects primarily through the issuance of debt. And when we say issuing debt, we basically just mean borrowing money. So governments borrow money to pay for these capital projects. That discussion of debt management is something we cannot do in the next 10 to 15 minutes, or cannot do a decent job of in the next 10 to 15 minutes. So I would propose that we hold off on debt management until next week. And so next week, what we'll do is the first half of class, we'll talk about debt, different types of debt, the advantages and disadvantages of different types of debt, long-term versus short-term debt. We'll talk about the process of how you issue debt. Do all that in the first half of class. Then in the second half of class, after a break, we'll turn our attention to revenue, and we'll talk about taxes, different types of taxes, their advantages, their disadvantages, and how they work. And then we'll also, if time permits, talk about non-tax sources of revenue as well. That will then clear the decks for our final Zoom session, where we'll get into a discussion of intergovernmental fiscal relations, and then wrap up the entire show with a brief discussion of the future of public budgeting. So that's kind of what it's looking like over the next couple of weeks. Any questions on capital budgeting and what we have covered up to this point tonight? Again, what's important, I think, for you to know is that how this capital budgeting process works, the importance of capital improvement plans, and some of the things that we look at as we compare capital projects to decide which capital projects to spend our money on. So any questions on capital budgeting at this point? Okay. If not, then I propose that we kind of call it quits for tonight at 8:20, and then we'll come back next week and start our discussion of that. Again, remember you've got Beach Board essay number 3 that is due on Sunday. 2 or 3 of those fiscal solvency indicators, calculate those, and then draw a conclusion about fiscal solvency for your city. And if your conclusion about fiscal solvency differs between what you saw in the CAFR compared to what you saw initially in the city's budget. All right. Any questions, as always, feel free to send me an email. I hope everyone has a really good week, and then we'll be back at it again next week. 2 more Zoom sessions, and then we are all done on July 1st. So have a good week, and I'll talk to you again next Monday.
All right. Thank you, Dave.
Thank you.
Thank you. Good night.